Hey everyone, this month I'm partnering with Questrade. They're building out some very cool investor tools, and right now they've got a great promo for In the Money listeners. I was actually just at their massive product showcase called The Dawn of Investing, and after meeting with the development team, I can tell you Questrade really is focused on building the future of investing right here in Canada. They've rolled out some real game changers, like they have completely redesigned Questrade Pro, which is now in beta testing. You can trade directly from best-in-class charts with lightning-fast execution, AI tools, and a full trader performance dashboard. The best part is that it's all free. And starting this December, you can actually trade assets like real physical gold right inside your account with Quest Metals, just like a stock. And they're the first in Canada to make cash-secured puts available in all your registered accounts except for an RESP. That's actually pretty huge. Sophisticated income-generating tools now available to everyday Canadian investors. But the one that actually really floored me was their 2026 announcement about custom indexing. You can actually take the S&P 500, dial down the weighting in one sector, dial it up in another, and buy those stocks directly. Why would you pay an ETF fee when you can essentially build your own customizable index for free? And for listeners of the podcast, you can use promo code INTHEMONEY, all one word, when you sign up for your first self-directed account and get a $50 cash reward. Or you can open a Quest Wealth Portfolios account and you'll get your first $10,000 managed for free for 1 year. Go to questrade.com, promo code INTHEMONEY. Hey everyone, it's a brand new episode of In the Money with Amber Kanwar. Today I'm interviewing Brianne Gardner of Velocity Investment Partners, part of Raymond James. And it's kind of an interesting week. We've got the Fed rate decision. It's the last one of the year, but maybe sets the tone for 2026. We talk about that with Brianne. And then we do my favorite thing and yours. We just talk about a bunch of stocks and which ones she's buying. Her highest conviction ideas, by the way, are all darlings that are recently under pressure. So some potential buy the dip opportunities. And if you want those pro picks sent right to your inbox, go to our website, inthemoneypod.com, sign up for the newsletter, and you'll never miss out. Let's get into it. The information provided in this podcast is for informational purposes only and does not constitute financial, investment, or professional advice. The views expressed by the host and the guests are their own and do not necessarily reflect the opinions of any organization or company. The host and guests may maintain positions in any securities discussed on the podcast. Always consult a qualified financial advisor or professional before making any investment decisions. When you choose a Raymond James advisor, you're getting more than independent financial management. You're getting access to complete financial guidance under one roof, from tax and estate planning to trust services for generational wealth and strategies for life's key milestones. Whether that's buying a home, funding your children's education, or preparing for retirement, they bring it together in one financial plan. What also makes Raymond James advisors unique is their complete independence. With no proprietary product to promote, you'll benefit from personalized services, all backed by the strength and resources of Raymond James, a powerhouse with $88 billion in assets and over 520 advisors nationwide. Discover how Raymond James can help you live a life well planned. Visit raymondjames.ca. Brianne Gardner, thank you so much for joining me on the show.
Thanks for having me as always, Amber.
I am so glad to be interviewing you in kind of this long form. You and I have had many interviews where I get maybe 5-6 minutes with you. But now we're going to really find out the real Brianne.
There we go. Love it. I'm glad to be here.
Okay, first let's talk about your investment style. We kind of said it was like Canadian, US, large caps. But what is it that really gets you going and interested in a stock? What are you looking for these days?
Yeah, I think our approach and how we really manage money and manage our clients' wealth is we do a little bit of top down and bottom up on our investment style, investment philosophy. We are active discretionary managers, so we take care of, the day-to-day, and we have a team that look after the decisions. Our investment committee gets together and we decide, on a specific stock sector, what we want to do and collaboratively make that decision. So we are focused on capturing ideally mostly 70 to 100% of upside, not always outperforming, but that's our goal there, and really limiting downside. So most of our clients have taken a lot of risks in life, whether business owners had exit, liquidity event, and they don't want to take on as much risk. So our goal and how we structure our portfolio in our active strategy is to capture about 30 to 50% of the downside of the market. So you're not feeling those full swings like you would if you were in an index or in an ETF, so to say, or just following the S&P 500 up and down in those waves.
All right. Well, I love that you're a stock picker because our mailbag is and our audience obviously knows you're a stock picker because our mailbag is loaded with questions. But let's start with the first approach, which is top down. It's December, a time of reflection. Maybe Santa Claus comes to town, but Santa Claus has been here in 2025. It has been I don't know, do you want to use the word unrelenting bull market? No matter what you throw at it, it's been Teflon.
Yeah, I think reflecting back on 2025, what we've experienced in the market, and even thinking of, January of what analysts had projected was to see about a 13-14%. You were seeing average analysts on the street target for the S&P 500. To be honest, we're in line with that. Then we started getting a little bit of a reassessment on that when Trump came out with tariffs and started seeing, downward revisions from where the potential upside we could see in the market. We still held strong on that. We did expect things to do well through 2025. And I think, as you mentioned, relentless market, consumers still strong. And we have seen exceptional earnings growth, right? 2025 was expected to see 11% year over year growth. And the positive thing why we're still bullish headed into 2026 is that earnings expectations through next year are supposed to be even higher. So about 14% growth. So all else being equal, that would expect the market to be up again from where we are today, another double-digit growth through 2026.
I think that's so important to understand. That has been the main driver. There's a lot of things to complain about, but as long as the earnings growth is there, that's really all the market cares about. That's particularly true in the US. And I just want to take a look at the Canadian markets in isolation because we've had a year of outperformance. In fact, the US markets underperforming global markets rarely has happened in the last 15 years. How much time do you spend thinking about why that is and whether the source of outperformance going forward is going to come from places outside of the US?
Yeah, I think as you had mentioned, looking at our top-down approach is really we look at the big picture, right? We look at macro view, we look at where we are in the business cycle, and that really helps us to determine first asset allocation, then sector allocation, because depending on where we are in their cycle, certain sectors outperform other sectors. And that's how we tilt the portfolio, overweight and underweight those sectors. Then from there, we dive down into what are the best stocks in those sectors and where do we see the most growth through, the next 12 to 15 months. Then we'll do, some tactical plays in there as well. So yeah, we are looking at geographic asset allocation as well. So, do we want to be overweight US? Do we want to be overweight Canada, international markets? Looking at South Korea, Japan, India, for example. But it is very selective when you come to those international and emerging markets as well.
So what are the answers to those questions? Do you want to be tilted towards Canada?
We have, I would say, if you're looking at our specific geographic asset allocation, we're about 55% right now in the US. And then we have about 40% in Canada and the remainder in international. We are looking at potentially ramping up our international exposure through 2026. But again, that vetting process takes a little bit of time for us to do that due diligence. So we still are bullish US through 2026.
Let's talk about how interest rates factor into that picture, remaining bullish the US for 2026. We are days away, when this airs, 1 day away from the Fed rate decision. And I'm really hyping it up as like the most consequential one of 2025. But I honestly don't even think that that's that far from the truth, because the whole market pivot, the whole market rally from the November lows was on this idea that we're going to get a rate cut. And the market is expecting a rate cut. But what kind of descent are we going to get at the Fed? What does the picture look like for 2026? And we've got a Fed chair changeup as well to contend with. These are big wild cards for the market. How do you think about that? Do we want to tune it out like we did with tariffs? Or is that a real factor to consider?
Yeah, I think for the U.S. specifically, we've seen about 1.5% of cuts out of from the Fed. This rate decision right now, I believe they're pricing in around 86% chance of a rate cut, 25 basis points from the Fed. So again, they want to continue on this path. And Powell, I think everyone will be watching to see the language of, is Powell going to say, yes, we're going to continue on this path of rate cuts, or are we going to be halting rate cuts and this is our last cut for some time? Definitely the language and guidance going forward is what everyone is going to be monitoring. And as you mentioned, Kevin Hassel will be coming in and taking over, and that will happen in May of 2026. And the thing about him is he's a big believer in that low rates are essential. So just that language alone tells me that he will want to continue to see interest rates come down, whether that is the best decision or not for the U.S. economy. But he certainly believes in more liquidity that will boost stock prices up for the U.S., push down weaker U.S. dollar, bring in foreign money, all, again, boosting the profitability of U.S. businesses.
And Kevin Hassett, of course, is the current director of the National Economic Council in the U.S. and is widely believed to be the next Fed chair, though hasn't been announced yet. But he basically said.
Yes. I feel like we're 90% chance is going to be him. But yes, if there is a mix or there is a change up, you never know. But it seems like Trump is leading that way. And I do think if he does come into the Fed chair role, we probably will get some preemptive rate cuts from the U.S., which, yes, could boost growth, but they do have to be a little bit careful on that rate direction. Whereas in Canada, I think we have done a really good job over the past 2 years of our rate cut path. Right, we did 2.75% of cuts, bringing prime down to that 4.45. So, we were close and still teeter-tottering a recession in Canada, not a technical recession. As you know, we need to see those 2 negative quarters of GDP growth. We haven't got that, which might have been, honestly, the dislocation between Bank of Canada cutting additional rates from the Fed and steering their own ship of being like, we need to make sure the Canadian economy is still stable and not into, a potential deeper recession. So I think they have done a good job on the rate path.
Does the rate path in the U.S. affect your outlook for 2026, or as long as there's earnings growth, you think it's a green light for stocks?
Yeah, I think we are confident that we will continue to see rate cuts through 2026. So that will boost the prices of the stocks and put more liquidity in the market. And you know what? One thing too about Kevin, if we are seeing more rate cuts come into the market, it's going to be a hard place for people with cash. And there is still so much cash on the sidelines that I think this will be a flood of people who have been sitting in money market and looking to deploy that capital. And with rates coming down and down, this money is going to flow into the economy, flow into the stock market, and again, should be profitable for those companies and businesses through next year.
Let's see if we can find homes for that cash and dip into the mailbag. The mailbag is brought to you by BMO ETFs. If you're looking for a smarter way to analyze ETFs or diversify your portfolio, especially by replacing individual stocks with ETF exposure, BMO ETFs has you covered. With tools like the ETF Compare tool and Market Insights, you can easily identify ETFs that hold your favorite stocks, match your risk tolerance, and align with your investment goals. To explore these tools, head to bmoetfs.com and check out the tools section. Okay, so since you cover both Canadian and US stocks, this is like a nice grab bag of both, some lesser known names and some more like household names. So I'm excited to hear what your perspective is. The first question is on NFI Group, bus maker, right?
Yes.
I would like Brianne's outlook on the bus manufacturer NFI Group. It's down about 33% since its high in the summer. Would you consider this a buy or a sell? This one from David in Nanaimo. Maybe talk to us before you tell us.
Yep.
Talk to us about why the stock's been under pressure recently.
Yeah. And you know what? That's a great question, David. Not a stock that we do own in the portfolio. They are pushing, engaging in manufacturing of zero emission buses and coaches. So that does offer kind of that sweet spot of mass transportation solutions. You think of New Flyers, Alexander Dennis Limited, Plaxton, MCI, etc. So their manufacturing segment does involve the production, service, and support of these new transition buses. Why we've seen, again, the stock kind of pull back. I think a lot of it has been, it looks recently too in the news, we've kind of seen it hitting a high post-summer, and then really October had quite a significant pullback there. And if we look back too, I think there was some...
It warned, right?
Yeah.
Its quarterly results, it warned, it lowered its forecasts. And, how do you make buses? Steel and aluminum.
Yes.
And so tariffs are probably a culprit here.
Yeah. And I think, as you mentioned, guidance came down, right? So analysts trimmed their targets, timing slipped, and most analysts still kept positive ratings because I think the long-term move towards that electric fleet hasn't really changed. Electric cars hasn't really changed. There are some bright spots too within the company, but I think the real challenge has been the execution for this company. Even with strong demand, supply chain issues and delivery delays can quickly overwhelm a good story and make results look choppy. And I think that's what we saw with NFI. So still a major North American bus maker and an important player in that shift to the EV or the electric transition. I think the business is tied to long-term government investment, which is positive too. Anytime we're seeing government investing in this phase or theme, but also to the ups and downs of the complexity, as you had hinted at, of the manufacturing cycle and materials there. So again, not really a chaser we want to chase after right now.
Okay, so not buying the dips in NFI. What about Boston Scientific? This question coming from Nicholas. It hasn't moved much in the last 6 months, but it has been volatile. Do you think that the current valuation is justified? And this is basically a maker of it's med tech, right? Like minimally invasive surgical devices.
Yes. And I like this stock. We actually recently added it to our portfolio. So, it hasn't moved much lately, yes, Nick, but the business keeps growing steadily. You're not going to see this, I don't believe, as like a high flyer growth stock that's going to take off. But we do see this company, fundamentally it ranks at 8 out of 10 for us. And it's engaging in, as you mentioned, the development, manufacturing, and marketing of these medical devices that are used to interventionally medical procedures. So it keeps growing steady. This is a business that is a steady grower, especially in high demand areas like heart rhythm treatments and less invasive procedures, which I think we're seeing more and more of those.
When you say it ranks 8 out of 10 for us, like what are some of the criteria?
Yeah, so we look at for one of our criteria, or some of the criteria we look at from a fundamental score. For example, we'll look at earnings per share growth. We'll look at revenue growth. We'll look at 5-year average ROE. We'll look at book value versus growth, long-term debt. So there are quite a few factors that we look at when we score a company, and it has to, from a minimum, to get into our portfolio, rank at least a 7 out of 10 before it can even come in. From a value score, obviously we look at more value from entry and exit prices, and some of those we'll look at earnings yield, adjusted cash earnings, dividend, book to market, P ratio, things like that, RSI levels. But I think Boston Scientific, this is, again, more of a steady compounder than a stock that is going to see those big jumps. So I think the valuation is fair. I think we continue to own it because it offers reliability, durability, and long-term catalysts rather than kind of short-term excitement. So I see actually double-digit growth in this company of upwards of about 20% from here. And I think if we're looking to of where analysts see the stock, you're seeing majority of a buy on the street about target price of almost 30%. And that target price is about 126, 127. So yes, it has been treading sideways, hasn't really done much lately, but I do think that we're going to see strong growth and momentum out of this stock into 2026.
Okay, interesting. Yeah, this one put on your watch list for sure, because I think there was a downgrade on it this week. Suggests, on this pullback. So this might be one that's up for good contrarian debate, or at least like a bull bear debate.
Yes.
And I love those stories. Another stock that we've got a question on is Fairfax Financial. This is from a chief who I know is a Fairfax guy. And follows you, Brianne, and said, Brianne has done an excellent job about explaining why Fairfax is an excellent opportunity for outsized returns, but she doesn't own it for clients. And we actually had an episode with Barry Schwartz who said he owned Fairfax personally, but not for clients. What does it take to get, you can have respect for a company and what it's doing, but what does it take to get it into the portfolio?
Yeah. And the hard thing is too, like how we position and choose the businesses in our portfolios. We do have about, I would say, if we're strong conviction plays, we're like 35 names to 45 names. So that's not a large amount of names. Some clients I see or portfolios I see have like 80, 100 names, right? So we keep them quite strong weights because of our conviction on them. Some of them can be 2% weight, upwards of 6% weight in the portfolio. We don't really like to go over 6. Again, you're getting a little concentration risk for us. So I'm still a believer in I hold everything my clients hold. My clients hold everything I hold. So I believe if I have a strong conviction and I like this company, I want everyone to benefit from this name. So Fairfax is not in the portfolio because we just have other names in that space. It doesn't mean that it's not on our watch list, or it doesn't mean that I might not add it later on. I think that it still has done well and still a great long-term compounder with solid underwriting, good investment returns, and still one of the better track records in Canada. So we agree to the long-term kind of return potential for Fairfax is exciting. I think the reason we don't own it directly, and what I mean by that is we own it through like an ETF that we have. So there is exposure that our clients are benefiting from, but we don't own it as one of our core individual names. Yeah. Yes. So Fairfax can be a little bit more volatile and somewhat event driven. So for us, if there's news and a stock is moving a lot on those news related things, it might not be a stock we want to own in the portfolio unless we want to benefit from that momentum. We want is the core mandates where we almost prioritize, as we talked about earlier, steadier earnings visibility. So it's important to note that we, again, don't have direct exposure, but we do have it through one of our holdings. So our clients are still benefiting from that long-term growth. And I think, as you mentioned, to own it directly, we'd want the right setup for the name. So a little bit more clear on the catalyst, better entry pricing, or room in our risk budget to add a little bit more of a higher beta financial name. So I still like their business model. We're just a little bit more selective about how it fits in our overall portfolio.
Let's talk about telcos. This is a widely owned sector, primarily for dividends. There was obviously some stock price appreciation a couple of years ago, and now that has turned to depreciation. Rogers is the question that we have from Dean in Toronto. My question is on Rogers. It's been slipping lately. And in fact, I think it's like 6 sessions in a row that it has been down. Dean bought thinking that the telcos were at a low range. Wrong again. Can you tell me your thoughts? Brianne, we can make this question about Rogers specifically, but I'd love your thoughts as well about telcos in general in Canada.
Yeah. And you know what? We did get some news recently in like the past few days about TELUS as well. We have seen some other stocks in that sector cut their dividends. People are worried about TELUS cutting their dividends. Rogers, another player in that game. they have been feeling the pressure, I'd like to say, for quite a bit of time. Honestly, I don't see a lot of their dividends I see as being stable. These aren't stocks that you're going to get the 10, 15, 20% returns from. These are the steady growers, the compounders that over time, you have the safety of this business that is not going anywhere. We go into a recession, we go into a trade war, we go into anything. These are businesses that are stable. Yes, their prices are going to fluctuate around more. And when we are still in like a strong bull market, these are not the stocks that are going to give you those juicy returns that a lot of investors want when markets are going up, like the Nvidia, the Googles, the Apples. These aren't those sweet spots. But from a diversification standpoint, I do see this sector doing well through 2026, 2027. And we have seen some upgrades in, for example, TELUS, that recently just came out saying people are now starting to put it back. And TELUS has been underwater for quite some time too. So for Rogers, looks like, again, fundamentally the company is still strong. But it's not a stock that we own in the portfolio. We have held TELUS. We actually added to our TELUS position.
After they said we're not going to grow the dividend.
Yes. So, right now you're getting a dividend yield of TELUS around 9%, which is, to me, very high.
Too high, some would say.
That's like, I always say, like the energy type of dividends you're getting, right? But with energy, you're taking that volatility, you're taking that risk, you're taking sometimes even hitting, the miners, being able to do that. And they're rewarding you as an investor by giving you a higher dividend to ride that volatility. Whereas TELUS, more of a stable business, and you're getting a 9% dividend yield. Yes, it's high for sure. Is it warranted? I don't know. But for us, we see value right now with where TELUS is. I would say it ranks almost like a 9 out of 10 from a value score for us.
Can you contrast that with maybe what you did with it? Did you own BCE after the dividend cut? Like, is TELUS in a different league than BCE? Those shares never really recovered. And quite frankly, even if you're owning telcos are supposed to be a diversifier. You said you want to limit your downside.
Yeah.
They've been a source of downside.
Yeah.
You know what I mean? Like they haven't even done that.
Yes. And you know what? We normally don't need to be active on these types of
That's
stocks.
Right. Yeah. They're supposed to be set
they're usually more of a buy and hold, as you mentioned, set it and forget it in the telco space. But because they have been under such water and scrutiny over the last bit. Bell, we never owned in the portfolio. Just we've always preferred TELUS over Bell. Looking at long-term averages, looking at the dividend yield, looking at the price appreciation. There's a few benefits and pros and cons we saw. I think Bell, you're seeing about a 12% upside from here. But again, TELUS, I think now with, a little bit more momentum, you're starting to see those analysts who are in the hold pattern switch over to the buy or outperform. So right now, analyst expectations are to see about 23% upside from here on TELUS. Is that going to happen overnight? Absolutely not. But now I think we just saw upgrade to price target of about 19% or 18.55. I believe Canaccord came out with that recently. So we are starting to see, again, analysts rejig on what those price targets are for TELUS, which is positive of knowing, okay, if they're coming out, analysts, and they're adjusting their ratings to higher numbers, they're seeing their earnings growth in those names.
It's interesting you mentioned the energy sector. And I wonder, do you own much energy?
I always say it's a sector I like to rent, not own longer term, just because of the volatility, because of, the risk, because of oil prices can move so quickly and so fast. So again, we usually like to play energy. So 2022, prime example, we're a little bit more overweight energy, happened to be the only positive sector year to date. Yeah. Obviously, if we had known that, we probably would have been more heavy over, but we reduced our technology, pretty much sold all of our tech stocks, except for we held on to Apple and Amazon and sold everything else and did very well through 2022 because of again, macro picture of where things are. So
are you renting energy now?
We are. I see, and this might be a little bit of a contrarian.
Love it. This is what it's for.
I see, like, when you start seeing oil at these levels and oversold and haven't seen a lot of run up in the energy space for a while, to me, that's saying, we might see another energy boom coming, which I like. And again, I want to benefit from that. I want my clients to benefit from that. So for example, even if I'm looking at the pipelines, that's a big player, stable businesses too. Pembina, one that we own, for example, in Canada, both value and fundamentally rank 8, 9 out of 10 for us. And year to date hasn't really done, pretty muted, up about 7% versus the markets. But we certainly see more upside from Pembina going forward. And that is a stock that I want to continue to hold. Enbridge, another example. So I think we are in more the large cap energy names rather than some of the small cap names.
This is why people have to listen to the whole podcast and not just pro picks, because none of her pro picks are energy names. But I think we got a little bit of a fun tidbit out of you about Pembina. We got a question on EQ Bank, EQB, I should say. It just announced a deal to buy PC financial assets from Loblaws. The market seemed to like it. The stock shot up. Does Brianne like it? This is coming from Rufus. I think EQ is in an interesting spot right now. It's been totally run over. It's the worst performing Canadian bank stock, which can be an interesting setup for 2026, but it's in kind of an area of the market that is like the punching boy when the Canadian economy isn't doing well, like it shows up in those subprime or more alternative lenders.
Yeah. And, I think if this company was like more US based, I think they would do amazing. But just with how the US, I think that the US lending and real estate and everything market is right there right now. But yeah, obviously the market liked the reaction to that news, as you had said. There's still EQB isn't a position that we hold. We do watch it here and there. I think you're seeing about 8% upside from here, but it is very interesting too. You're not getting a huge dividend yield from the stock, about 2.4%. I think we're a little bit more in the bigger names, and I think more in the US too. I think I like some of the US financial names right now over some of the Canadian. Royal, I'm more in the banks from that standpoint. Yeah. But that's kind of where we've been positioning.
So larger cap Canadian banks is your preference. And
yeah, we just got earnings out of Canadian banks, had a very strong week last week. But I still think we want to be positioned that way rather than some of the other small financials. And not necessarily that there isn't more upside in EQB, but for us, like the JP Morgans, the Bank of America, those are kind of how we've been positioning our portfolio. JP Morgan is one that we've held for quite some time, years, and have traded it a few times, trimmed it back. Wells Fargo, and then we've actually sold all of our banks except for Royal Bank in Canada. So I like, I think we're again looking at where we see interest rates headed. We haven't seen as many cuts out of the US as we have seen in Canada. The amount of mortgages and up for renewal that we have seen in Canada has been significant. And I just think the spending that we're going to continue to see, if we're looking at geographically, we see more upside in the US consumer getting out there, spending, borrowing, leveraging at this time, especially with the big, beautiful bill passing, rather than Canadians from that perspective. I'm not saying that the banks aren't going to continue to do well. I just think they've had a really, really strong run, and it's not a bad time to be taking some profits.
Okay, let's talk just 2 US stocks before we get into your pro picks. I have to talk to you about this Netflix situation. I've actually been ignoring the bidding war for Warner Brothers. I just thought it was like an American thing, not interesting. And then Netflix gets involved and shells out, pick your number, but let's call it an $80 billion plus. They've never done anything like this. Yeah. Their last biggest deal was $100 million, just to give perspective. So shells out to buy Warner Brothers. And President Trump says, I'm going to look into this. And the shareholders don't seem to like it for Netflix. All of Hollywood doesn't seem to like it for Netflix. This is a big move for Netflix that was dominating, beating Disney, beating the Mag 7, relentless outperformer. Then as it's gone down this path, Brianne, it has struggled. It's at a 7-month low. It's down 25% from its all-time high. Some of that can be warning signs. Some of it can be fun for a buy the dip. A buy the dip investor. What do you make of this whole Netflix situation?
Yeah, Netflix has been on our radar for some time. One that we're currently doing some due diligence on. I like the stock. Honestly, we are doing some hard vetting right now, looking at the potential upside from the stock. It ranks a 9 out of 10 for us. Are we going to be adding it to the portfolio? We might be soon. Price target, we see about 20% upside from here. And I think the deal definitely ensures, and I just actually got the notification on my Netflix account, I believe it was like last night, being like, oh, exciting news. You're going to have access to Warner Brothers now. So I was like, yes. But I think
what they didn't tell you is, and the price is going to go up.
Right? Oh, those streaming services. But we're all hooked on them. So we keep paying. I think the deal structure that we've seen certainly ensures that Netflix acquires this high growth studio asset while still avoiding the declining linear network business through a planned spinoff. So we're seeing management expecting to see this acquisition to generate significant cost savings over the long run, and to earnings per share growth within the second full year. So that's pretty fast for a company to do that and then see that growth. And I mean, it's been a decade-long battle we've seen for the streaming dominance, right, in the entertainment sector.
My question is, would you pull the trigger before you have clarity on the deal actually getting done? And I say that because I mentioned Trump saying he's not going to kill it, but he said, we're going to look at it. And there are reports that Paramount might goes hostile, right? Which sparks concerns about, well, does Netflix have to pay even more? There's a huge break fee too, over $5 billion. Like if this doesn't go Netflix's way, right? That's a big payout.
That is a big payout.
I guess my question is like, we kind of had this with Couche-Tard. Remember Couche-Tard, its pursuit of 7-Eleven, it just put Couche-Tard in the penalty box for a while.
Yeah.
And I wonder if Netflix is going to live there until this gets sorted out.
Yeah. You know what? I would say that's certainly a risk an investor could take is buy the news. Definitely a contrarian bet for us. If I'm just going to use an example. If we vet Netflix enough and we like this and we want in and we want to take that risk, we would probably buy a half position. So let's say, we want a 4% weighted Netflix. We're going to buy 2%, execute on that trade before this all gets finalized. If the stock pops, great, we'll add again. If the stock pulls back, great, we'll buy our second half. So, or we might sell if we think it's going to go sideways. I don't think Netflix is going anywhere, but as you mentioned, this is a massive price tag. That has, initially on the news has caused Netflix stock to pull back a little bit as well. So even if we're looking year to date, yes, the stock's still positive, but we have seen since July kind of that downward side trend and then quite a short-term sell-off.
This week, in addition to the Fed meeting, I feel like everything also rides on Oracle. I love to hype up these events in the markets. And Oracle is interesting for a bunch of reasons, but it's the wobbliest AI trade. The stock has pulled back dramatically. The cost to insure against a default of its debt has spiked up. And you can make of that what you want. Others have said, oh, that's just a hedging strategy. It's not real concern. Is there real concern around Oracle for you, right? Because it's getting a lot of money for AI, but it's like, it's all getting it from OpenAI.
Yeah. And honestly, Oracle has been on our watch list for so long. It is a stock we want to add to the portfolio. So again, right now, on this downward trend for us to also get this, we would want to see a turnaround before we add to the position. So we have seen a little rally up, but I would say slight from what we want to see is a conviction of a turnaround in this stock. I'd say bullish reasons for Oracle for us is that some firms see Oracle as an AI almost super cycle leader, right? They have a $280 price target. So that's up 40% from here. Some analysts on the street think more 55% upside after this pullback. So looking at kind of that 339 target. Yes, there's some caution over leverage and sustainability of the AI-driven growth. I think the AI and cloud pivot, right? We've seen, as you talked about, the OpenAI, $300 billion OpenAI cloud pact, which is a multi-year hyperscale deal with Meta, TikTok, et cetera. So their revenue for Oracle is up 52% year over year. So that is, very, very strong growth. Their SaaS growth is slower, about 10%, but the remaining performance obligations they have, still are some things that we're watching closely. The CapEx, guidance is still there, focused on AI data centers. And the revenue outlook is expected to be for fiscal year 2026, about that 14 to 16% year over year growth. So still positive. I think they're going all in on these data centers and the AI making deals with OpenAI, Meta, and TikTok. I think their revenue growth is super strong, but the investment into the CapEx needs future revenue to stay strong. And I think that's going to be a big trend in the AI space overall, is to see this growth. Is it going to be continuing at these levels? Are we going to see this double-digit growth? Or is it going to become a little bit more muted and then turning AI into profitability? That is what everyone is watching. Yes, we've invested hundreds of millions of billions of dollars into AI, but what is our ROI, or what's our return on these investments? And that's where we're going to start pivoting. So I think this cloud-based services is growing a little bit slower and the debt is growing, but still a stock that we are waiting for a entry point.
Okay, let's find out what stocks you're not waiting for an entry point and that you like, your highest conviction ideas. ProPicks is brought to you by ATB Financial. With $62 billion in assets, ATB Financial is powering possibilities for more than 820,000 financial services clients in Alberta and beyond. ATB's capital markets arm is a full-service investment dealer that offers investment and corporate banking, sales and trading, institutional research, and risk management. Visit atb.com/inthemoney for more information.
Yeah. So one of those is Capital Power. This has been one of my picks, I feel like 2 years ago. I think in the power optimizing of power generation facilities, still one of Canada's major power producers. They're shifting their fleet towards cleaner, more modern generation, while still providing dependable cash flow, which is important to us. I see long-term contracts for the company that has helped stabilize their earnings. And the company continues to really invest in the natural gas space, the renewables, and repowering those projects that extend their asset life and improve their efficiency. So the earlier pullback we did see in Capital Power, does present a great buying opportunity. And I think it was really reflected and those concerns were because Alberta's power market and financing costs. So it wasn't anything, huge extremes. And I think Capital Power has been strengthening its balance sheet and moving key growth projects forward. So positive for us. I think analysts are seeing solid value here, noting the resilient cash flow and strategy that aligns well with the whole grid's transition towards cleaner energy.
So you would buy the dips here. I think part of the, when you see a stock move lower like that, some of it was on Alberta pricing concerns. Their results were also not super stellar, but that wasn't enough to shake your confidence.
Yeah, I would say this is more of a value, maybe you can say contrarian play. But I would say with this pullback, this is looking like a favorable entry point for long-term investors. So it's not always that you get these types of pullbacks in these stocks. And for us, with that, I think it is presenting a good buying opportunity for investors.
So another stock, I think we do have a theme. You said there was no theme in your stock picks, but I think I found the theme, which is darlings that are that have drifted lower.
There you go.
TMX,
I like that.
TMX is another example. What a relentless outperformer TMX has been. And then it's just kind of melted lower over the last 2 months. What do you see as kind of the key driver is that? And why are you stepping in? And when I say melted lower, like it's down 10% from its all-time high, but
Yeah, I think, you're right. I think darlings that have had pullbacks, slight pullbacks, finding opportunities, especially in a market that, as we talked about at the beginning of this, been resilient, you need to find these pockets. You need to be active and you need to be selective. And I think TMX Group is a great example of that in the financial space. Really the backbone of Canada's public markets, running the Toronto Stock Exchange and benefiting from long-term capital rising activity as the economy grows. So we have really seen TMX Group business model evolve over the years. Data and analytics now make up 42% of their revenue and are growing double digits. While derivatives trading has also accelerated. So I think, as we talked about, that recent pullback was tied to fewer new listings going public, but I don't always think that's a bad thing. I know quite a few companies who are holding off, waiting for their timing to go public on whether it's Canada or the US. I think they are being strategic there. So I think the strength in the data and the derivatives keep their earnings steady, which is still positive for the stock. Again, why we're comfortable holding this and as a top pick. So analysts are beginning to recognize that resilience in TMX, and we're seeing some upgrades and views that TMX valuation could move closer to peers as this story continues.
It seems like part of the concern has to do with what's going on and evolving, like in crypto, but not really crypto, just like stable coins and blockchain and TMX basically experimenting with what that means, right? If you can tokenize the value of your asset versus, like, to your point, issuing a share, going public, like is TMX going to be part of that, or is TMX going to be disrupted by that? Maybe that's kind of like an overhang or an issue here.
Yeah. And I certainly agree. And I think a lot of people underestimate, TMX from that standpoint and where they are making investments. But also, I don't 100% believe that Canada needs IPOs to, reverse this. I think they still have that momentum.
And so much of their business is like, it's not actually the exchange, right? There's like it's diversified into so many other areas, and it's a data company. And again, you could throw in like AI.
Yep.
Is AI then disruptive to TMX?
Yeah.
Because you can get sort of the same information, and maybe I just type it into ChatGPT or whatever.
Yeah.
Or is TMX going to be, scraping its own data for value?
And honestly, I think data is going to be where a lot of value is going to be coming from in the next 12 to 24 months, is going to be on these companies that have done their job in collecting data. Data is going to become so valuable, and what they do with that data is going to be really how we're going to see companies develop.
Okay, let's bring in your third pick, which is Meta, the owner of Facebook and WhatsApp, growing, spending, and the market just got a little freaked out by that recently.
Yeah. And I think we actually used this recent pullback to add to our position in Meta. We still have been a holder, but I still think there's more upside from here. Meta ranks fundamentally a 9 out of 10 for us, and yes, has done a good job. I think analysts are seeing either outperform or buy few holds, but about 25% upside from here, looking at a price target of about $8.39. So, 25% when you're seeing some of those big tech names is quite a big move. So for investors who want a little bit more of that super large cap still participating, I think Meta does continue to deliver strong momentum in their core advertising business. And that's the better AI recommendations, deep engagement across their global platforms. Reels has become really the major growth engine of everything, social media. And I think Meta can successfully monetize new formats as users' behaviors continue to evolve.
Brianne, it has been an absolute pleasure. Thank you so much for joining us and sharing your ideas with us.
Yes, thanks so much for having me, Amber. I loved it, and it was great to be on In the Money.
Oh, thank you. It was great to have you on In the Money. That's Brianne Gardner joining us at Velocity Investments. Don't miss our next episode. We are talking all about commodities with the head of commodities at TD Asset Management, Hussein Aladina, joining us. You can send us your questions, email questions@inthemoneypod.com, and we'll see if Hussein can answer them. We'll catch you on the next episode.